All right. So today is Monday, July 7th, 6:30 p.m. session of 758P. Recording is on. I am Professor Profetti, and our focus this semester in the online MBA will be on equity analysis. Just as a word, all of the sessions will be recorded, and since the university Panopto system sucks, all of the recordings will be posted on YouTube. So post-class, I'll put a link in the announcements so you can go and access them there as well, in addition to the Zoom recordings online. But I've found over the years that people have a lot of trouble with Panopto and no one seems to have trouble with YouTube. So just FYI. So as we get started today, I wanted to quickly kind of go over just the syllabus and kind of talk about the solutions to your first homework assignment, and just kind of go through questions and answers and kind of set up the semester and going forward with that. But let me go ahead and start by sharing my screen. So again, welcome to 758P. It's called Applied Equity Analysis. And from my perspective, the key word is applied. We're assuming that you're far enough into your MBA careers that you would have gotten kind of the core financial content. And this is really going to be more practical application of that content in a real world setting relative to valuation and company analysis. Basically, I'm going to talk to you and train you on frameworks that would be used by a sell-side analyst on Wall Street to evaluate companies. The class is broken into kind of 4 sections. The first section is called EIC, Economy, Industry, Company. Basically, it comes from the idea that Michael Porter started this, but approximately 50% of the performance of a company is the external environment. And so we're going to look at that environment and help us understand the companies that we're evaluating through that context. The second section of the class will look a little backwards on kind of historical financial statements. As you probably saw in the video, I like to say you can't drive a car looking in the rearview mirror, but we need a baseline to value companies. And this, for many of you, will probably be the most challenging section of the class, because I'm going to be introducing some language developed by McKinsey around Modigliani Miller, which basically takes historical financial statements and puts them into an economic format. It's an extra step that is not usually taught in many classes, but by doing so, you'll start to get better understanding of what's going on with the companies, and it will set us up to do our forecast valuations. The third section of the class will be valuation. We will be doing real world valuations of companies tied to real world data and real world forecasts. And I'll talk to you about how to build a reusable model that is used in the real world. And the fourth section of the class will be on multiples, PE multiples, enterprise value multiples, etc., which are not unrelated to valuation. As a matter of fact, law of one price. There's only one value for a company. Doesn't matter how you come at that value, you still got to get the same answer. And so basically, multiples are the shortcut for valuation. I'll show you it's really just rearranged math, but we'll understand what the drivers of a company's value are, and we'll triangulate the multiples back to the valuation. Those are kind of the 4 main sections of the class that we will go through. The textbook that we are using is McKinsey's 7th edition. Now, last month, they just came out with the 8th edition. And starting in the fall, I'm going to actually start using the 8th edition, but we are using the 7th edition. And as I looked through it this summer, they gave me a preview copy. It's different. So the chapters that I'm referencing for all your assignments are the 7th edition. Great to have the most recent edition, but unfortunately, just the timing of when the class started and when they released it. So basically, kind of give you an overview of what we're going to do week by week. The important part for you is that each week there's a series of assignments that are based on videos that I've primarily taken in my undergraduate version of this class. So I teach 190 undergrads in the fall and 190 undergrads in the spring. And I like to make the content topical and relevant. So you're not going to get case studies from 1990 Southwest Airlines in this class. You're going to get case studies from Southwest Airlines right now. So that's the type of work I want to do. So the videos, for the most part, were shot this spring. And your assignments are based on data that I'm giving you this summer. So just FYI. And I will post the data that you'll need to do the assignments kind of week by week. You'll be doing those assignments in parallel with a team project. So when we think about grading in this class, there will be individual assignments, one a week for the next 6 weeks, right? Or at least 1 or 2 a week. There'll be a midterm, that's 40% of your grade. There'll be a midterm exam, which we take, I believe, in week 5, if I remember correctly, which would be 2 parts, and again, 20% of your grade. But the real core grade is week 7. So you should have signed up today into a project team. And essentially, at the end of the semester, you will make a presentation for 40% of your grade, covering all 4 sections of the class on a real world company that your teams will choose in week 5. And so you'll select a company, and I will give you all of the data that you need from the data sources. And then you'll basically do the analytics and presentation. So essentially, you can start thinking about the companies that you want. If you want the data sooner, I can give you that sooner. But essentially, if you think about each of the sections of the course, the final presentation covers all 4 sections. And so you'll practice individually, but then as a group, you'll be graded holistically across all the sections on a company that you choose with current data, following the processes of the class. And so I'll just let you know that the class got a little bigger at the end. So we now have, I believe, 6 teams, which practically means just the last class is going to run a little long. It'll go a little bit longer than 90 minutes for your planning, just because everybody's going to have to present that day. So just letting you know in advance. Typical grade distribution for the class. In terms of attendance, my perspective is this. I'm going to record every class. If you're going to miss a class, and I already got somebody who said they were having a trouble, my recommendation to you is let me know in advance. Okay. So if you're going to have trouble turning in an assignment on time, or you're going to miss a class, work, whatever, I understand life happens. Just talk to me in advance. I generally am more forgiving before things happen than after the fact. Now, when it's an emergency, understand you're in the hospital, car wreck, death in family, completely understandable. But got a work thing, can't make the class, not going to be able to submit by deadlines. Don't tell me 2 days after the deadline. I just won't grade it, won't accept it. So flexible in advance, inflexible after deadlines. Just think of that as a rule this semester. And again, I'd like to make this not me talking. So participatory comments, very, very much welcome, and questions. And happy to continue it throughout the weeks as we go through. Please follow the Honor Council. Don't do anything stupid. I hate referring students to that. If you have any issues, please let me know in advance. Disabilities, DSS accommodations, etc., work schedules. We can try and work things out accordingly as we go through the semester. The only other thing I'd say about the Honor Council is I know that ChatGPT and Claude and others have become a way of life. And my perspective on that for this class is you can try and use it, but if you use anything, it must be sourced. If you use an AI agent and the AI software looks like AI software, I will consider that an academic violation and refer you to the Honor Council for that. So just like you're sourcing an article, if you're sourcing AI, you better quote it and or put it in a bibliography or footnote it. Okay. So you can't use AI to write your assignments, right, and not credit it. That is my standard, even beyond the university. But if you do use it for help, and I'm just saying I use it too, practically you got a source. So AI is a source, no different than anything else. Somebody just had a hand.
I did. For the assignment one that we had, I
Yep.
didn't use AI to like come up with the responses, but I did type out like everything and then I had it rewrite it because I couldn't
Bibliography.
blur.
I,
Okay.
I'm not going to, for Simon one, fine, but going forward, I'm just saying, I think it's just a good general practice in today's world, especially in an academic setting,
Hmm.
that we, if we're using anybody else, then we got to credit that in some way. So please just put a bibliography. Okay? And again, I use it to summarize all the time myself. So it's not anything anybody's not doing. All right. What else is there? So again, assignments. We had 2 this week, which we'll talk about in just a minute. Basically signing up for groups. That was the easy one. And then the key value drivers. Next week, we'll start the first section of the class, which is EIC. And I've already put up the data for that outside the videos for you to be able to access that assignment. Okay. So kind of see the schedule of assignments here throughout the classes. Hopefully pretty straightforward. Let me just open up. Any other questions administratively about anything? Anybody have trouble accessing any of the videos or submitting anything?
Where can we find the videos?
So basically, in here, if you go to the home screen, like for example, in week 2, they're embedded where it says watch. Like there's a video, there's the videos. So that's week 2's videos. And by the way, when you click on that, that goes to my YouTube channel. So when I post stuff, it's going to go to YouTube. Matter of fact, I've been posting it for 7 years. So 7 years of historical classes are on there. Not that anybody wants to boring watch something that happened 5 years ago. But basically, as I said, I'm somebody who's never been a big fan of Panopto. So everything goes on my YouTube channel. Okay. But that's basically where the videos are coming from. And then you can direct link. And again, as I post more this semester, I'll give direct links in the announcements for the live classes. Great question. Any other questions? All right. So the other thing about this class is that good news, bad news for you, is that this class uses Bloomberg extensively. And I don't know if anybody here has access to or has used Bloomberg Professional before. Unfortunately, it doesn't work as well in the online setting because of the cost of the software. We have a lot of licenses, but you physically have to be on campus to access them. Bloomberg only makes 2 exceptions, and I am one of them as an instructor to allow them to use Bloomberg outside of campus. But unfortunately, if you get to campus, you're welcome to use the terminals. There's 32 of them at College Park in a classroom, which is my teaching classroom. Another 10 in the lab. There's a few in downtown DC campus, and then there's a few in Shady Grove campus. But unfortunately, unless you're physically at the campus, you're probably not going to have access. So I will be sending you data from Bloomberg this semester. That's really the one sad part of this class is I really wish we could put it into an online environment, but the software costs $25,000 per user per year on a subscription basis, and Bloomberg does not want people to just access it online. So they kind of lock it down. But for those of you that may not be familiar, Bloomberg Professional is the pro tool. So generally, if you work in the financial community, it's the software that you're using every day as a trader, fund manager, analyst, etc. It's very powerful software. It's a trading tool. It's information news tool. It's a system of record. It's got a lot of data in it, 34,000 screens, 1.6 million companies around the world. So this semester we'll use about 10 screens, focusing on some of the equity. But nonetheless, you'll see a lot of references to that in the videos and the data that I give you. Yeah, Evan?
Yes, just quick question to follow up on that. If we want to use the Bloomberg like terminals, is there any process that we need to go through, or is this more of a question for you offline? Because I'm more than willing to drive down to, main campus just to play around with it, do research, do whatever.
It's super cool, and I'm going to show you a few of it in a second. It's actually really easy, and I'll show you how to register. It takes 3 minutes when you're on campus.
Awesome. Sounds like a plan.
Because the way Bloomberg has set it up is they assume that if you use one of the terminals at the campus, that you're a student, and they just give you an automatic access. We just sign up for an account, it works. But that's the problem. You got to physically be on campus at a computer to do that. It won't work remotely. So unfortunately.
Awesome. Thank you.
So yeah, in a minute I'll show you that. Any other questions? All right, well, I'm going to jump to Bloomberg now then to illustrate the first point, and then we'll come back to key value drivers. So let me, now I'm actually logged in, so I'm going to log out. So Bloomberg is now software. It was built in the 1980s by a guy named Michael Bloomberg. He's a billionaire because of this. Started out with what's called a terminal, looked like a calculator in the 80s. And he started on the bond market. And all the bond trading firms basically said, we all do the same thing. We need a trading platform. We all need a data platform. Michael Bloomberg's like, hey, I'll be the clearinghouse. And we'll all agree on how to crunch the numbers. And I'll store your data, calculate in a consistent way, and allow you to trade bonds. And he built it. And it was so successful that Wall Street expanded it to everything else. Now, over time, as technology has moved on, it's purely software today, but they still call it the terminal, just legacy. All right. So if you go to College Park, there is a computer lab, Van Munching Hall 3505. There are 32 terminals in that lab. There's also some terminals on the first floor of College Park. I forgot what the room number is, but it's the main computer lab. And they have some Bloomberg terminals in there. Shady Grove, DC, I don't know where they are, but I know they're down there. It's not that big. So basically what will happen is you go to it's Windows only, right? So I'm on a Mac, so I run Parallels, but essentially it's software. That's the icon, right? So you just click on the Bloomberg icon and it will try and load the software. Now, the very first time, if you actually want to build your own account, down here, it'll say create a new login. Right? So you click on create a new login. Real easy process. Are you creating it for yourself? Yes. It's almost like a trick question. Have you ever used it before? I don't know if anybody here is a Bloomberg user. If you are, you don't need to come to campus. So no, not a Bloomberg user. And then down here at the bottom, go next. And then you basically type in your name, first and last, and you pick a login name, okay? Mine is J Profetti because I've been a terminal user for a long time. J Profetti would be taken. You can be J Profetti 262, whatever, and it'll just verify that it's a unique login. And the login is not an email address, okay? So it's an actual just login name. So it verifies that, and this next part is important. Put in your mobile phone and any email that is attached to you. It doesn't have to be a UMD email. It can be a Gmail, it can be a work email, but the phone number is probably more efficient, right? Once you do that and you hit next, it's going to say, we're going to send you a verification code, 6-digit code, to either your email or the phone number that you had put in here. When you get the code and you type it in and you hit submit, it'll then ask you to choose a password. And then once you do that, you have an account. That's it. It's real straightforward. And then using the system, different story. Excuse me. I'll try and put a little PDF on, getting started, but just FYI. So let me see if I can get out of the screen. Now, there's one other thing you can do if you are interested. If you are interested, this is on a web browser. The Zoom menu's out of the way. It's called Bloomberg for Education. Okay, portal.bloombergforeducation.com. Okay, or if you just type in Bloomberg for Education, it'll bring you to the site. Okay, so bloombergforeducation.com, but it brings you to this page, portal.bloombergforeducation.com. This is where you can become Bloomberg certified. It's called a BMC certification. It's a real certification, right? And it's actually pretty valuable in the financial community. Matter of fact, all the undergrads, as soon as they get a job on Wall Street, first thing, got to be BMC certified. I actually certify them as part of my class. I make every undergrad take this certification in the first 3 weeks of class. Basically talks to you about how to use the terminal and other things. So if you want to have access to that, you can have access to that as well. Okay. Certification costs $149, but as part of this class, you can have it for free. So cost to you, $0. Okay. And so here's how you get certified. If you want to understand more what the tool can do. So basically you click sign up, and this is the important part. Okay. When you sign up as a learner, you need to type in an email address. Very important. It has to be a umd.edu email address. If you use any other email address, because this is a completely separate account, web account versus the terminal account for the certification, it will charge you $149. It'll ask you for a credit card. Okay. If you use a umd.edu email address, it will give it to you for free. And I'm all for free. So you have two. All right. I'm profetti.umd.edu. I am also profetti@terpmail.umd.edu. Okay. But regardless, you should have a UMD account. So basically you put in your UMD email and password and name, and then sign up. Okay. If you have that, it'll then say, oh, you're a student, cost $0, proceed. The whole point is when you sign up, if you choose for the certification, back here and log in. Zoom menu keeps getting in the way. Password. Okay. Once you log in, this is for the certification, which is online. You can come over here to what's called certificates. And essentially they have several, but the one that involves the terminals right here, it's called Bloomberg Market Concepts, BMC. That's the certification. And so if you click on that, it has a series of modules that when you complete, you get a PDF that you can do whatever you want. And you can also put in your LinkedIn profile and your resume. But I wouldn't put it on there if you don't do the certification. So long story short, there's a course, it's an online course on economic indicators, currencies, fixed income, and equities. Those 4 blue badges are the required certification modules. They also have extra modules, which are not part of the certification, but you can take them. One is called Terminal Basics. how to use this incredibly complex and not easy to use software. So they throw that in there, as well as other modules on commodities, options, and portfolio management. So essentially, it'll remember your progress. So for example, for EIC, economic indicators, it'll kind of go through, and essentially the modules include videos, text, and quizzes. And the very important part is, if you don't do the quizzes, they won't give you the certification. So if you don't care about that, you can buzz through the questions. But I'm telling you, if you didn't watch the videos, there's no chance you're going to get the quizzes right. So, but nonetheless, that is available to you if anybody is interested. Optional. All right. So again, completely separate than the software. It's just a certification for the software, but explains how to use it and shows you some very powerful things. All right, so back to where we were. So I'm going to log in. So once you have an account and you type in the software, sharing. You won't have the second step in the lab. This is the second step, which is a biometric authentication to prove it's me on my phone, so I don't share my password for the remote access that they have given me. So there's only 2 people at the school that are allowed to use Bloomberg off campus, myself and a professor named Sarah Kroenke. That's it. Everybody else has to be on campus, but we're the ones that teach the equity analysis class, and she manages the Senbit fund. But regardless, this is the software. And start out with top news. One of the nice features of the tool is it actually gives you all the headlines real time before, because it's real-time newswire feeds from everything. So this is one of the screens that a trader will have open all day. Sometimes it's kind of depressing to look at, but regardless, you get all the news. You don't need the Wall Street Journal anymore, or the Financial Times. But basically, I want to talk about this in the context of the 4 cornerstones. So you guys tell me, first cornerstone, what was it and why was that important?
I guess it was important because it just gave like a idea of how the value is created through with the company.
Okay. And so specifically, what is the first cornerstone? What's it all about?
It's one of them was generating more cash.
That was number 2.
Uh,
2 is cash.
Is it your ROIC has to be greater than your weighted average cost of capital in order to create value?
Exactly. It's called spread. And the whole point is, you took Finance 101 or whatever it's called these days. And the whole idea is that IRR has to be greater than R, or you can't have a positive NPV. Well, it just applies in the real world. And the only difference is the terms have changed, right? So when we talk about the R, the hurdle rate, the discount rate, the cost of capital, interchangeable terms, the WACC, essentially the IRR is essentially the average rate of return over time has to be greater than your hurdle rate, or you can't have a positive net present value. Well, the only difference is we throw in an additional term called ROIC, return on invested capital, which is a 1-period IRR, right? And the whole point is, over time, that ROIC/IRR has to be greater than your cost of capital, or you can't create value, can't have NPV, right? And that's what plays out not only in projects, it plays out for companies, right? And part of the reason is that ROIC, also called return on capital employed in Europe, also called return on net assets, also called return on capital, or ROI. We just keep changing the terms around. It's all the same stuff. But the whole point is, it's a proxy for cash flow, right? So if you have a 10% ROIC, you're generating 10 cents of cash per year. If you have a 20% ROIC, you're generating 20 cents of cash per year. And if your hurdle rate is 10% and you're making 10, you're not creating any value because you're just paying off the interest. That's called a zero spread. Okay. Spread is the difference between the ROIC and the cost of capital. Right. Now, so one of the things I put in the video and we will do here is give me a company, any company, anywhere in the world, publicly traded. Jacob?
10 cent.
Okay. So here's 10 cent out of Hong Kong. One of the nice features of the tool is you can do real-time benchmarking. So it's the short code is RV, relative valuation. So you go to any company and it'll give you a default list of competitors. Now, it's called CompSource. You can have your own custom list. You can also use what's called BICS, which is the Bloomberg Industry Classification Services. So the algorithm for Bloomberg will say, here's who we think are the companies that are most related. Sometimes it'll also have an analyst curated one where the analysts will all get together and say, these are the ones we like to look at for this company, and Bloomberg will just have that as a default list. Or for fun, you can just create your own list to your heart's content. Right? So I'm going to use the BICS list. So here are the peers of 10 cent. And right now I'm using global, right, based on the firm. And again, here I could also look at different parts of the firm. So for example, if I want to just look at peers that are in internet media or video games, blah, 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 but these are the big peers. And again, these are in Hong Kong dollars, and I'm sorry, I don't think that way. So I'm going to switch this to US dollars. Not that it's going to matter because we're going to talk about percentages, put the bigger companies up front, but so these are some of the bigger peers that it's listing here. Uber, Booking.com, what else we got? Spotify, DoorDash, Airbnb, blah, blah, blah. But the whole point is all these predefined templates, which you're going to start seeing this semester. But one of the nice features of the tool is you can go to custom, you can go up any data point that you want. And so what I did in the video is I looked up ROIC, return on invested capital, and the tool says, which one do you want? And I'll say latest filing. So this would be through probably June 2025, annualized 12 months. And what's nice is this top row in white, this is very important to your assignments, is the industry average. It's the average of all the companies on this scrollable list. And it's adjusted for size. So it's a weighted average. Okay. And then the other column that I add, it's called the WACC, weighted average cost of capital. And this WACC is calculated today. Top row in white is the WACC of the industry based on all the companies on the scrollable list. And the first row down is 10 cent. Right. And so this is going to be very important for your next assignment, reviewing next week. Looking at that top row in white is 10 cent in an attractive industry. Is this a value creating attractive industry based on spread? Anthony?
I would say it's not because the WACC is close to industry average, but the ROIC is significantly lower than the industry average.
We're talking about the industry, the first row in white.
Oh, sorry. I thought we were talking about 10 cent Pacific.
We're going to do 10 cent next. Yeah, we're starting the industry first.
Yeah, it creates value. It's 20%. The ROIC is 20% higher than the WACC.
Yeah, and that's called a positive spread. And anything that has a positive spread is positive NPV and would be a value creating industry. That's a key point for next week. Hopefully it's pretty straightforward. Okay. Then we'll go one row down and we'll look at 10 cent. Okay. Is 10 cent creating value? John?
They are just at a lesser rate than industry average.
Correct. Go one more row down, John. American Healthcare REIT. How would you score them?
They have a negative spread, so they are not creating value.
All right, Hopefully pretty straightforward and easy. Now let me get to the C part of EIC next week. This is the I, okay? And that we're applying the spread concept to, the first cornerstone. But the second concept is competitive advantage. And what I want you to understand is everybody thinks they're good at something, but that is not true. No matter how bad you are, all right? So basically, competitive advantage is about outperforming your peers, right? So the way I want you to start thinking about competitive advantage from a financial lens is if you really have advantage, you outperform your peer group. If you're not outperforming your peer group, you do not have competitive advantage. You're in a good market, but you're not better than everybody else, okay? And through that lens, does 10 cent, which is creating value, demonstrate competitive advantage?
No.
They do not. Does GoDaddy, row 103, demonstrate competitive advantage?
Say more than 10 cent.
Potentially, but the answer is a yes or no question.
That's a no.
It would be no. Because even though GoDaddy's making a 29% ROIC rounding off against a 9.26 WACC, and they're creating value, they're still below industry average of 31.5. Now, the problem is you got some companies in here, VeriSign, Rightmove, Bookings, AutoTrader, Pinterest, which are really outperforming from a technology standpoint. And that's the point. Those companies are demonstrating competitive advantage because their spreads are much higher than the industry. Okay. And I'm just saying very important nuances can be covered in the video next week, but this is part of how we're going to start applying spread this semester. And we're going to define an attractive industry as one with a positive spread. And we're going to define company's competitive advantage as outperformance to the industry. Okay. And it's very important. Matter of fact, you can actually destroy value and have competitive advantage because you actually destroy less value than everybody else. Just, it's kind of quirk is the way we start thinking about this, but that's the way I want you to start thinking about it. Okay? Now, the other point of this is I'm going to save this as a template, so I don't have to rebuild it. Let's call this my 758P template. So we're going to look at another industry in a second. But before we do, I also want to make two other points that were emphasized in the video. Number one, growth doesn't create value, right? And we need to separate between good and bad growth. Because if American Healthcare REIT cranks up the growth and they're borrowing at 8 and making 1, their situation just gets worse and worse and worse. That's part of your key value driver exercise. Okay. So growth is the accelerant to value. It's not value in and of itself. And the other point is approximately 50% of your spread is your industry. Right? That was the Buffett quote I think I referenced in the video, which is Warren Buffett just said, he's 92 years old, shocked the world when he announced that he was retiring this summer at the end of his 5-hour Q&A session at the annual meeting. People were like, I can't believe it. He's retiring. The guy's 92. How could they not have thought the poor man deserves a break after all of his 50-year career? But the point of the story is he said it in his paraphrasing Mr. Buffett. He said, look, I don't invest in companies. I've always invested in industries because the industry is more important. You pick a company in a bad industry, nothing they can do. Find the attractive industry, then pick the winner. That's the secret to success. In fact, one of the last questions he got during the annual meeting this year was about 5 Japanese companies. And at the time, they said, when are you going to sell them? And he said, never. Kind of shocked the audience. And they're like, what do you mean never going to sell? And he and his new CEO that he appointed, essentially, said, look, we look at Japan and these markets that they're in Japan as great long-term markets. Why would we want to sell the companies that are the best companies in these long-term enduring markets? Like, that's what we look for. And so that's served him well. And every now and then the markets change. Something that used to be attractive becomes less attractive. Okay, we move on, right? But, or some company that was good, it's not so good anymore, we move on. But that's very important to understand. So understanding the industry is really, really important. And spread is what investors are looking for. Because again, it's a proxy for cash flow, right? Got to have a positive spread to create value. That was the first cornerstone. Okay. So just to illustrate a couple more points, give me a couple more industries we'll run through with current data. What else do you want to look at?
Can you look up CLS? I just did a report on them.
CLS?
Yep,
As in-
Celestica.
Yeah, sure. What did your report say?
I said I would buy them. I did it like 6 months ago, so
Okay.
not that recent, but it was to
Okay.
get into the global equity fund.
All right. So if I look at their industry, you tell me.
The industry is not doing so hot.
But how are they doing?
They are doing a bit above their industry average, but their
But
WACC is
a
also,
lot of risk.
yeah, a lot of risk.
So they're doing better, but they seem to be perceived as a much more risky company. By the way, that's another important nuance as I start floating around some data here. Notice how the WACC will change industry by industry because certain industries are perceived to be more risky than others. And that kind of starts to show up as well in our analysis. But this is a tougher industry. Okay. Are there companies doing well? Not many.
It's one of
Apple.
the AI industries, so they're
Yeah,
very
so it's early,
flexible right
early
now.
inning.
Yeah.
Exactly. Anybody else you want to look at real quick?
Alibaba. That the ticker is Baba. Yes.
Yeah. Okay. Same thing. Alibaba, you look at the data, not doing as well. Industries, not bad. Borrow 10, make 14. By the way, that's another key point this semester. Use numbers. Do not make general statements in your submissions. You will not get credit. This is a finance class. It's not an English class, right? So you have to use and reference data, meaning when you're answering your questions, and I say this in the video, you can't just say Alibaba is not creating value. That's meaningless to me because that's a 50-50 shot and you may not even know that you answered the correct question correctly. What you need to say when you write something up as an assignment is Alibaba is not creating value because it has a 10.29% WACC and an 8% ROIC, and that negative spread is why it's not creating value. You must use numbers all semester, just period. Standard I use. And good practice for real world. In the interest of time, I'm just going to show you a couple of others. Southwest has been in the news recently with all their changes. I was laughing at the article where they interviewed the CEO of the New York Times. He's like, all of our changes for seat fees and baggage fees are what the customers wanted. Like what PR firm coached him. But if you want to see why discount airlines had to change their business model, there's your answer. You know what the article also did reference that the CEO said is that by charging for baggage fees and seat assignments, it's going to add $4 billion a year in profit. That's what they were giving up with their traditional business model. They had a broken business model. They couldn't earn a positive spread because the airline moved to making all their money on fees. Airlines make more money on fees than fares. And so that's the point. It's a real tough industry if you don't charge fees. And so these discount players, which haven't been charged as much fees, particularly Southwest, they had to change their game because otherwise, who wants to invest in this, right? So again, just give you a sense, tough industry. If you want to look at good, we'll take, oh, sorry, looked off the screen. Well, something like a Meta. So social media, tech firms. That's why you save your templates. But the point I make, and this is going to show up in the videos next week, is that you're going to start seeing some industries are more attractive than others. And it's much easier to make money in an attractive industry than an unattractive industry. There are always outliers, but we don't look for outliers. All right, second cornerstone was about cash, right? And it's about cash, not income, right? If you remember that. And the whole point there was that income will eventually equal cash, but there's timing differences. And in finance, we care about those timing differences. Third cornerstone, Robert?
Sorry, just a quick question. Maybe I missed this. Does it tell you the industry that it assumes the competitors are in?
Is what, I'm sorry?
Does it tell you the industry, or the industry that it assumes you're looking for? Did I miss that?
Well, not necessarily. It's, as I said, the way that it works is you usually pick the company and it'll tell you what the peers of the company are, rather than just going to an industry. Like, maybe there's a way to do it. I haven't figured it out. But but regardless, and then like I said, you can see who, like, these are the company reported competitors for Meta, as you define industries. But basically it's really company driven.
Gotcha.
Now there's other tools. But I want to get to the third cornerstone, because that's about the future. And that's about expectations, right? And just remember that, and I referenced this in the video, that this is a parlor trick, because we're looking backwards. And we don't make decisions about valuation on historical data. I don't care what you did in 2024. I care what you do in 2026, because I don't get the cash from 2024. I get the cash you're going to generate in 26. You're worth the sum of your future cash flows. Expectations are critical. And that's going to be very, very important fundamentally beyond this class, but particularly this semester. So that's the problem with the data. Even this data is last year. So it's not that Apple had a great year last year. What's going to happen next year? So what's the company that you said you just did your analysis on 6 months ago?
Celestica, CLS.
CLS. So this is coming up, but one of the things is there's a group of people, and you're going to learn to think like them, called the sell side analysts. And for Celestica, there's 16 of them. It's Carl Ackerman, who works for BNP, Timothy, what's his name, Long, who works for Barclays, Ruben Roy from Stifel, Samik Chatterjee from JP Morgan, blah, blah, blah. These are the people that write the buy, sell, hold recommendations. These are the people that also come up with the target share prices for the companies that they're selling research to. Wall Street sells $4 billion of research a year that is paid for. So those research reports you hear about, which are all in here, you got to pay for them, and they're not free, and they're not for individuals, they're for institutions. So basically I'm BlackRock. I got a fund of like 30 different companies in my portfolio, can't keep track of them all. So I hire specialists and I pay the specialist to tell me what to do. So these people don't own the stock, but they're the ones who are unmuted in the conference calls, and they're the ones very important to what happens to a company stock. So if I look at today, real time, long term, buy, sell, holds, this company's got 15 of the analysts covering, of 16 analysts call them a long-term buy. Buy is worth 5 points. One says hold, which means they don't think the stock price is going anywhere. None say get out. So long-term, 4.88 out of 5. The market is very bullish on this company. They also have a 12-month target stock price. Each of the analysts does a version of Excel, which you're going to do this semester, learn how to do it, forecasting the company. Comes up with a DCF value. It's called a 12-month target share price. These are the 12-month share prices of their DCF models. They upload them to Bloomberg. Bloomberg averages them. The average 12-month share price for this company is 127 in their models. Right now they're at 154, which basically means there's negative 17% upside the next 12 months because the stock is up 167% in the last 12 months through this morning. So the problem is everybody figured out they were doing well. Everybody bought it. It's too late. So it's not that the market doesn't understand the future. They paid for the future in the last 12 months. And if you're just getting in now, you probably missed the short-term boat. But there's still a long-term opportunity in this company that they believe. And so where does this data come from? We'll take Carl Ackerman, who updated his data on July 1st. This is Ackerman. He's got 19 companies that his team covers. Let's see where he works out of. He works in San Francisco. That's his phone number. That's his email. And that green dot means he is currently on Bloomberg and we can IM him. And because it's a system of record, he would actually respond. I'm not going to do that because he'll block me. But regardless, he has a team. Usually it's an analyst, an MBA, undergrad in finance, maybe if it's semiconductors or something, probably an engineer. But the whole point is they're the ones that are writing research. As a matter of fact, this is all of his research on this company. It's right here. All of his paid research is on this screen. 71 documents on this blank screen. Do you know why my screen is blank?
You have to pay for them all.
Exactly. This is how Wall Street makes money. This is the $4 billion. So, but it's here. Just can't get it without paying it. But one of the things they do is they also sell their models, their Excel models. You can access them. Again, you got to pay for them. And so each of the models are actually uploaded to Bloomberg. It's a clearinghouse. So essentially, over here on the right, are all the models and everything that they're forecasting about this company. Now, this is one period. If I click on multiple periods, it will have both historical and forecast data. Okay, so how much they're going to sell year by year, going forward, blah, blah, blah. And so what happens is, even though they sell the individual models, because they upload to the Bloomberg, what they all allow Bloomberg to do is average all the guesses across all of the models. And the average guess across all of the models is called the consensus estimate. So if you ever wonder where the estimates for the companies come from, it's the average of all the guesses of the sell-side analysts that are uploaded to Bloomberg. And so when you read in the Wall Street Journal that a company missed or met their numbers, that's where they're coming from. And this is the detail. There's a summary screen you're going to start seeing this semester, EEO. These are the next 4 years of average guesses. So for example, last year, actual 9.6 billion in revenue. By 2028, expected to be 16.7 billion in revenue. EBITDA, 770 million last year, 1.6 billion by 2028. Free cash flow, 300 million. They don't have a 2028 forecast, but growing to 553 million. So these are forecasts, and they're based on this summary detail of their businesses. Okay, so all this is forecast. So this is future. And so what I want you to understand, just conceptually, as we go through the semester, is that a company's worth the sum of its future forecasted cash flows. These are the people that are most important, along with the institutions that own the stock doing their forecast, but they're hiring these people that are basically forecasting the cash flows, and they're discounting them, and they're coming up with values. And those values are leading to that share price. So anytime the consensus changes, it's going to change the value of a company. Okay, and that's expectations. And that's the third and very critical cornerstone we're going to spend a lot of time on the semester. And that's what you're going to start doing. You're going to start forecasting, and you're going to learn how to model out the forecast reasonably using data. And that's really the third section of the class, right? And probably the most important section of the class. We're going to build up to get there. So, and then the fourth thing is competitive advantage, which we've already referenced. And the key to competitive advantage is, number one, you got to beat your peers. But number two, it's transient. Just remember, competitive advantage is transient. It doesn't last forever. So it doesn't matter if you have an advantage, it's eventually going to go away. Everyone loses their competitive advantage. So the question we're going to have to try and assess is how long? How long do you maintain your competitive advantage? And do you have a what's next? That's what's key. Because look at Intel. 10 years ago, Intel dominant. Today, irrelevant. And if you If I told you 10 years ago that Intel would be irrelevant in 10 years, you'd have laughed and dropped the class. You're like, what's this quack saying? But that's what happened. And I'll tell you, the next company that's under threat, it's called Google. Why? What's the challenge that Google has right now that is incredibly disruptive to their business? Robert?
I know one of the big things is that they're facing antitrust lawsuits, like with Google Chrome.
True, but that's not the killer. That's not what's going to kill the company. They can just bribe Trump.
Fair enough.
Tyler?
So one of the biggest like proponents was like their search engine dominance. So with AI, a lot of people aren't using Google to search anymore. And although they do have Gemini, they don't have that dominant like market share they did with search. So that's their biggest issue that they're going to face right now. And also getting revenue on AI is a little bit more difficult than search engine, especially with the ads.
So right here, 200 billion a year. These are ads. All right, Robert, you're going to add to that?
Oh, no, so I'll take it down. I was gonna say the same. They're just cannibalizing themselves if they kind of go into that.
Anthony, did you want to add?
Yeah, I was gonna say, I think most tech industries right now are kind of struggling with not having a big like landscape shaking invention. They're all kind of scrambling, trying to figure out how to make AI profitable. And I think everyone's kind of struggling with it.
Yeah, but the problem is the way Google makes money, 200 billion a year. You can see it right here, which is the core of their business, right? And essentially, actually, sorry, Google search right here. Every time you type in a search in Google and click on a link, they get paid. And the more links you click on, the more they get paid. And it's been one of the most amazing business models ever built. And they've been working on AI for a while, and they backburnered it because of the problem that the AI means you don't have to click on the links, they don't make as much money. And then 3 years ago, ChatGPT showed up and the game changed overnight. And I don't know if you guys how much you use ChatGPT for other types of searching, but just to illustrate something, this is the death of Google in real time that they don't have an answer to. And I'm going to show it to you. And this is what I mean by competitive advantage. Share. Okay. So if I go to a new chat and I just say, I'm looking for a shelf to put under a TV hanging on the wall in my living room. No more than 24 inches high. This is the problem. Do you know what happens? And I've just started. If you click on any of these links, you know how much Google makes? Nothing. And that's the problem, is that these AI bots have gone beyond just asking basic questions. They're moving into everything, including shopping and everything else and search. And they're better. Matter of fact, I had to get a prescription at the Maryland, especially prescription at the Maryland pharmacy, and I couldn't figure out their number for their website. So I asked the A-bot and it gave me the number. Google couldn't figure it out. So I'm just saying, like, as people are not using Google and they're using AI to buy stuff, and it gets very, very specific, they lose the revenue. Matter of fact, last month, what the Google CEO told his advertisers is Gemini, because they made a change. The change they made is they added Gemini to the main search engine. And he said, look, right now, if people search Gemini, we don't get paid. We haven't figured out the business model for it. And that's a real problem for Google. I mean, yeah, I didn't get $20 a month or whatever you can sign up for, but the 200 billion is under threat. And so the point I want to make here is not detailed today about Google and exactly Kodak with the digital camera. So some put that in there. And Palantir is doing some interesting stuff too. But the point is, it doesn't matter how good you are. All right, your competitive advantage is not going to last forever. And that's what we have to continually assess as we're thinking about valuation. And those are kind of the four main cornerstones. Now, the other key thing you had for today is, and Jacob, did I not answer a question, or did you want to add something?
Yeah, I was just going to mention with respect to Google that it's kind of an example of the innovator's dilemma, where they have all this inertia because they're a giant company with an established business model, and they're hesitant to expand or experiment in emerging technology because it hurts their existing bottom line, or at least they fear it will cannibalize from them, and that ultimately kind of sows the seed of them getting their lunch eaten.
Yeah, that's a great point of an application. And we see that play out again. And that's what I said. The difference in this class is we're going to do it with data. And you're going to start looking at data when you make your assessments. Right? So beneath the cornerstones, and this is the key to this week's assignment, is the math. Okay. And the math is called the key value drivers. Now I put up, because I don't think when they set up the course for me this summer, the actual slides that were in the videos. So I put as a link, these are the slides that are in the videos for video weeks 1 and 2. And if you want them as reference, I made as an announcement. But this slide is the one that summarizes all the math. Now we're going to get into more detailed math as we go on, but what it says is the math for valuation at a very high level are 3 things. 1, it's spread, ROIC and WACC. That's going to drive value. Number 2, growth. It's important as an accelerant, but it's one of the variables. And 3, sustainability is what we're calling competitive advantage. How long do you maintain the growth? How long do you maintain the spread? All right. Now, spread, as we drill down, ROIC is a function of margin, how much you make, and productivity, how much you invest in your balance sheet to drive sales. Okay, that's what we're going to call productivity or efficiency. So it's balance sheet productivity. Okay, so 5 things emerge as key value drivers. And this is a framework that comes from McKinsey. It's in the book, but this is what we're going to be using this entire semester. And so this assignment, the very simple one that you just completed for today, is probably the most important thing I can teach you this semester. Because 5 things drive value. Margin, how much you make when you sell something. Productivity, how much you spend to sell it and how often you sell it. Cost of capital is risk, growth, and advantage. That's it. That's the valuation math. Okay, it's called key value drivers. And this is the magic formula. So again, highlighting what was in the video. Difference between a project and a company, companies end. Or sorry, well, they end too. Projects end. Companies are supposed to last long term. So when I value something very long term, theoretically forever, Google should last forever. Then we get into what's called a perpetuity, perpetual cash flow. And the basic formula for growing perpetuity, which says I have a constant cash flow growing at a constant rate forever, at a constant discount rate, is cash flow divided by R minus G. And that's what we use for long-term valuation of companies. It's what's in all the textbooks, right? But that formula has a flaw. I think there's 2 flaws. Flaw number 1, we're literally taking the entire long-term value of a company and breaking it down to 3 numbers. Get over it, it's what we do. But number 2, that formula assumes that the IRR on incremental investments equals the IRR on historical investments. Translation, whatever return you make today, you make forever. Never changes. So what ends up happening practically is when professionals apply the traditional growing perpetuity company valuations, you can take a company that's performing poorly and it will never improve. and you'll tend to undervalue the company because they'll never get credit for future improvement. And you'll take a company that's doing really, really well today, like NVIDIA, and they will never decline. And it just assumes they're going to be dominant forever, just like Intel. And that's unrealistic, and you'll tend to overvalue them. So what McKinsey did, and this is in the book, is they rearranged the math. Okay, and it's explained in the video to the formula on the right. That formula right is called a key value driver formula, which is basically growing perpetuity. The difference when they rearrange it, the math, is instead of forecasting free cash flow, we forecast profit and ROIC independently, which lead to free cash flow. And that ROIC is incremental, which means by using the key value driver formula, we can put in a different ROIC/IRR for the future than the past. Now it's one for the entire future of the business, but at least we can put in something more representative. So your key value driver exercise that you did today was based on this formula. And when you did this, you came up with, and you should have written, 4 scenarios, right? There was actually 6 things you did, but 4 key scenarios I want to make sure that we all understand. So I'm going to pull up the spreadsheet that you wrote the paper on. And what this spreadsheet had done is it took that formula that was on that PowerPoint slide, and I put it in that cell for you with the correct order of operations. And these were the 4 elements of the formula. And I use friendlier terms. Okay. So expected profit, long-term growth rate. So this is not a 1-year growth rate or a 5-year growth rate. Think of this as like a 30-year growth rate. This is expected return, and this is WACC. And the other key word is expected. This is all about the future. It's not about the past. So you got to be careful. You don't want to use last year's numbers. You want to use future numbers, anything that you do for real valuation. Okay. And that'll give you a value of the company. And by the way, value divided by profit is a multiple. That's all it is. So what were the scenarios that I asked you to do in the assignment? What was the first thing I asked you to do that you wrote up?
Was to modify the profit for company A to 200 and then 300.
Yeah, let's put it here. And so when we did that, what happened?
We
What
saw the
changed?
value increase.
Did the multiple change?
No.
So the grading question, why not?
Because you just made the company bigger.
Yep.
Instead of like actually increasing value. I mean, not value, but like increasing efficiency and making it more. I don't know how to word it correctly at the moment.
I like what you're saying. That sounds like something I'd give you credit for, but I think you're right. You're kind of onto the point. Like one way to create value is you just make an absolute more amount of cash. You're bigger. Okay. But nothing changed about your long-term business model, which are the next 3 drivers. So you're not better. Okay. So one way to drive value is just become bigger, just make more money. But I also want to focus on why would people pay more for your profits? What makes you better? And that's where the key value drivers come in. And the key value drivers are right here: growth, return, risk, growth, spread. That was the next part of the assignment. All right. And these are the 4 scenarios I want you to understand. So you reset. And then what was the next step? Step 2. Now, what did you change? After changing the profit, what did you change next?
Was it to modify the growth rate for company A, even though there's not going to be a positive or negative spread?
All right. So we start cranking up the growth. Company A, what changed? I went from growing at 5% a year, growing at 7% a year, to growing at 8% a year. What changed? Yeah, John?
Nothing changed for company A when you change the growth, just because they have a zero spread. So maybe they're doing more transactions or less, but they're borrowing and getting returned at the same rate.
Yep. So the idea is, and this is key to your grade, is that if you do a bunch of zero NPV projects, you get a zero NPV. And when you got zero spread, you got zero NPV. So when you have zero spread, your cost of capital exactly equals your return, growth is irrelevant. I like to call this the treadmill. You run really fast, you don't go anywhere, and you don't create any value. And companies are often surprised. They're like, I'm growing. Yeah, but you're putting all the cash back in to grow, and you're not really creating value. Now, what happened when you cranked up the growth in the second scenario for company B? What's different here? I know, John, you just answered. I'm going to give somebody else a chance. Somebody else we haven't heard from. I'm going to start calling on people. Who haven't we heard from? Mariah, we haven't heard from you. What's going on with company B?
Both the value and the multiple are increasing.
Why?
Well, it's likely because well, I mean, it is because the ROIC is greater than the cost of capital, but it's likely that the company is expanding and they're in a market that is probably doing pretty well, or they have a pretty niche customer base that is growing at a pretty relevant rate.
Yeah, but technically the first part of your answer is the most relevant here, which is the ROIC is greater than the WACC. So when you have a positive spread and you grow it, you start creating value exponentially. That's what we're looking for long-term as investors. We want the high growth, high return companies because those are the ones that are creating value, and they create a lot more value because they do more of it. So this is why growth becomes important in the conversation. Good growth, bad growth. And I deal with this with real world leaders all the time, which is basically explaining to them, like, not all growth is good. Because if you're just growing a break-even return, you're not going to get credit for that. If you can grow a high return, that's what everybody wants to invest in, because that's the one that's going to generate all the cash. So these are your stars. These are your superstars. This is where all the value is created. Scenario number 2. Scenario number 3, reset. What was the next scenario? What happened? What did we do next with company B in the assignment? So we cranked up the growth for company B, got a lot of value. And then what was the next part of the assignment? Where do we go next?
Change the growth rate to 3%.
So growth slows. And so what happens?
Value declines.
Why?
Because it's growing at a slower rate, even though it's got a positive spread.
So this is the company that becomes the cash cow. They have high returns, but the growth slows. And this is an illustration of the expectation cornerstone. I price you as if. I price you as if you make 20 cents a year, growing 20 cents at 8%. I realize I was too optimistic. You're going to make 20 cents a year, but you're only going to grow 3%. Well, 20% growing at 3% is worth a lot less than 20 cents growing at 8% a year on a compound basis. And so that's what happens to maturing companies. Is maturing companies, if it's not no other reason, a law of large number effect, basically see their growth rates decline and their values and multiples will come down because they lack the long-term growth, even if they have high rates of return. And that's another very important scenario. Scenario number 3. So you got the treadmill, growth and no spread. You got the star, growth at high spread. You got the mature cash cow, the company with high spread but no growth. And then we went to the fourth scenario. In the fourth scenario, we said make the spread negative. And then what do we do? Next part of the assignment.
Increase the growth rate.
Okay. And then what happened?
Well, now we're on the decline. We're scaling negative because we have that negative spread. So even though we're growing, we're not making smart investments. So we're inherently just losing the money.
Exactly. And this is why I mean growth is the accelerant. So you're just doing more and more of those bad investments that you're talking about, and it just gets worse and worse and worse. You're just throwing money away. This is the black hole. So what's the solution here? If you're in the situation and you can't change the spread.
Stop growing.
That's the other part of the scenario. Watch what happens when the growth rate starts to slow. 7 becomes 3. Watch the value of the multiple. 3 becomes 0. 0 becomes -3. Avoid the bad growth. Hey, doctor, my head hurts. Why, Mr. Profetti? I've been banging it against the wall. Well, stop banging it against the wall, right? And that's the whole point. This is when you harvest. This is when you sell off. This is when you shut down. You don't invest in these companies because they don't have a future, right? They're the ones that you just get whatever cash you can out because you want to fund it elsewhere. And those are the 4 core scenarios. Now, the final part is the more advanced nuance. And a lot of people overlook this one. What was the last thing I had you do in this week's assignment? Pat?
I think it was like change the weighted average cost of capital.
Exactly. So what happens? What did I say? Go to 8, 8 and 12?
8 and 7.
Yeah, we'll do 8 and 7. Then what happened? And why?
Value increased because the spread changed and it became better.
Yes, and there's an and here, and the and is the important one to get full credit in this assignment. It's not just the spread's higher. And for those of you thinking about this, I'll keep the spread at 0. 10 and 10, watch this. 10 and 10, 20 and 10. Okay, 0 spread, 8, 8. Notice that the value in multiple is higher at 8 and 8 than 10 and 10. Notice the valuable is higher at 18 and 8 than 20 and 10. Why? Spread's the same. Is it Jaron? Do I have that right?
Jaron, is it because the price of capital is less?
And I think you're onto it, but keep going. Therefore,
it's yeah, I don't know.
Ryan, you want to give him an assist?
Yeah, I mean, is it because it's less risky?
Yes, put in the financial context. So you got a lower discount rate. So that means what?
Higher cash flow.
It's not a higher cash flow, it's a higher value. So if I discount a cash flow at 10%, it's going to be a lower value than if I discount a cash flow at 8%. That's just DCF 101. So that's the point. People often overlook this, is that when the risk changes, the values of the companies change, even if the cash flows don't change. Because if hurdle rates go down, all things being equal, those cash flows are worth more. And the opposite is true. If the hurdle rates go up, 12, 12, then value goes down because I'm now discounting those cash flows at 12% versus 10 or at 8%. So this is the other nuance, a little bit more advanced, but important for you guys to understand the semester. I call this the sixth scenario, which is basically that hurdle rates matter. As a matter of fact, if you want to look at what's going on with the economy in the last year, that was one of the challenges we're facing now, is interest rates are going up. And when interest rates go up, it's a headwind to market valuation. Because all things being equal, if companies make the same amount of money and interest rates are higher, then they're paying more, which means we're going to discount those cash flows at higher rate, and those cash flows aren't going to be worth as much. And so that's the fear factor of the Trump tariffs, right, in the marketplace today, because those tariffs are inflationary. They just are. And the whole point is when inflation goes up, interest rates go up. So it's the bond market that's driving this, not the stock market. And when interest rates go up, borrowing costs go up. And when borrowing costs go up and cash flows don't go up, stock prices go down. That's what Wall Street continues to fret about right now. Now, it hasn't happened yet, but that's the danger, okay? Because otherwise you got to get more cash flow to offset the higher discount rate, okay? And so at some point, something's going to break here, but that's back to EIC, and that's what a nuance that's very, very important. Matter of fact, that was actually the boom of the last 10 years when interest rates went to all-time lows. And when we had like 2 and 3% yields on artificial, but nonetheless, we had them. And so with cheap money, stocks got real expensive, real fast, because the discount rate was so low, everybody could borrow the cheap money and those cash flows were worth a lot. And we convinced ourselves that was going to last. Well, party's ending. That's also the problem with deficits. Because at some point, here's a good trivia question. Over the last 10 years, who is the biggest buyer of U.S. Treasury securities for our $2 trillion a year deficit? Someone's got to buy all that debt the Treasury sells. Who's the number one buyer over the last decade? Yeah, Robert? I'm sorry?
Japan.
Nope, not Japan. Joe?
China.
Nope, not China.
Okay.
Tyler?
Was it Berkshire? I don't know
Nope.
if that's right.
Nope. John?
The Federal Reserve.
There you go. Ding, ding, ding. Right answer. We buy our own debt. It's called printing money, 21st century version. So basically what happens is the Federal Reserve, independent, at least until Trump makes it otherwise, has the ability to print currency, and they control the currency. So what happens is at Treasury auction, there was a gap and there wasn't enough buyers to buy all the debt for the deficit. So what happened is the Fed increased their balance sheet by $6 trillion, buying all of the debt. And that allowed interest rates to remain extraordinarily low. Because if they didn't print the money to buy the debt, we bought our own debt, then interest rates wouldn't have been 2 or 3%. And the last few years, the Fed said, this is bad because printing a bunch of money leads to inflation. Duh. And now they're like, we're not going to do it anymore. And so basically got out of COVID, they stopped buying the debt. It's now sold in the open market. Interest rates went from 3 to 5%. And that's the problem, is that right now the Fed maintains that posture. And it's probably a good posture because you don't want them to keep buying the debt because inflation is going to spike dramatically again. Then we're paying higher interest rates. Well, that's a headwind on the marketplace. And you see that in key value drivers. So 2 last things. These are the things you need to say in your assignment, by the way. But I also want to make this somewhat practical. In the 1970s, there was a company called BCG. And they came up with a very famous 2x2, which still exists today. And what they did is they looked at one axis, they looked at growth, and another axis, they looked at market share. And the assumption was, if you had a high market share, you made money. Well, we quickly realized that that didn't really work. Just having a lot of market share, you can give stuff away, don't make money. But that was the 70s. It's been updated to say instead of high market share, it's high return on investment. So this axis is return, low ROIC, high ROIC. This is low growth, high growth. And there are 4, got to have a 2x2 if you're a consultant, quadrants. And this is what the key value drivers illustrates. When you have high growth, high return, proxy high spread, those are called stars. When you have no growth or low growth and high spread, those, sorry, my terrible drawing skills here. Those are your Chick-fil-A cows, cash cows. Up here, you got high growth, you're not making any money. Those are called question marks because you don't want them to go down here. No future. They have no growth in the future. They can't make money. They used to call them dogs. Now I have a dog, and the idea of killing my dog doesn't appeal. So I changed it to black hole. You're just flushing money down the toilet. That's when you harvest. And that's the point of a question mark. So portfolio management is pretty straightforward, right? What we all look for are the stars. That's the value creation, right? The cash cows are important in this process too, for a different reason. The problem with the cash cow is if you let a cow eat, it will eat itself to death. And so they make high returns. In the real world, they say, gee, we're making all the money. We should get it back and decide what to do with it. No, because if you give them the money, they don't have growth opportunities. They're just going to reduce their returns. So portfolio management is you take the cash from the cow and you give it to the stars who need the money to grow. And then you got your question marks and you figure out, what do you do with them, right? Do I invest in them to make them stars? Or do I give up on them because they're just become black holes? And then portfolio, black holes. What are you doing here? You're just throwing money away. Business is done. It's past its prime. You've lost your all advantage. Like, get out. Take what you can. And that's portfolio 101. I was working recently with a company called Bosch. They have 1,000 products. There is no company that has 1,000 products that are all in the growth mode. You have to think about it like a portfolio. And you just can't let things go on forever. And it's all in the context of the key value drivers. So whether we're doing valuation, whether we're doing allocation, whether we're doing investment analysis, whether we're doing decision-making relative to finance, this is how things work. And this is how we're going to be taught to think this semester. And that's why key value drivers are really, really critical. And the last thing I'll leave you with, I'll go back to Bloomberg, is I want you to start reading news articles in a different way. I'll show it to you in Bloomberg, but you can pick any news article, any business news article. Because if you understand these cornerstones, you should understand what's going to happen to the company. Okay. So for example, Samsung profit halves on US chip curves. Right there. Just read the headline. Think like a trader, apply key value drivers. What should happen to their share price and why? What are they illustrating in the key value drivers? What does that headline tell you? Samsung profit halves on US chip curves. Robert?
The valuation should decrease because their profitability is decreasing.
So in our key value drivers, which one of the drivers is going down?
Expected profit.
Which is the ROIC.
Or, yeah.
So they're going to have lower return, and they're also going to have what?
Higher risk.
Well, if they have chip curves, probably low growth, less growth, even if the risk doesn't change. So I'm saying they're expected to have less growth, less return, potentially more risk. That stock's going down. And I'm just saying, you'll start to see how these are going to play out because that's how a trader thinks. I'm thinking as a trader, almost like real time, like, all right, what do I think the value is going to be? What we're going to do is we're going to try and dig deeper and actually try and get to what we actually model it out to be. That's the detail we're going to get into this semester. The principles are universal and they go well beyond this class. So that's kind of like what you should have done in week 1. Week 2, we're going to start breaking this into pieces. So the first piece is EIC. It's the model to explain the external environment. Basically, go through the videos. There's 2 of them. And then your assignment, I believe I gave you data for week 2, EIC, and in here it's on Nike. So I have taken in the assignment screenshots. So when you go to the assignment, oh, where did I put them? I think I put in the announcements. So in the announcements, I have put the screenshots from Bloomberg to do the Nike assignment. This is from last week. And I've downloaded the analyst reports for Nike that I have access to from JP Morgan and other firms, Barclays, Deutsche Bank, as well as something called BICO, which is basically a summary Bloomberg gives of what all the analysts are saying. So it's kind of like a curated version of what the financial community is saying about the industry of the company. So as you do your write-ups, use this data to help you answer week 2's assignment. And it's all current as of last week. Okay, so I know we covered a lot. Fire hose off. Questions, comments, concerns, crippling fears before we go. Evan?
I apologize in advance if this is the naive question, but assume that your growth matches your WACC or your growth rate is higher than your WACC. What can we do with the key value driver formula to appropriately evaluate that company's value?
It's not a bad question because I get it a lot. Short version is it's a mathematical impossibility in a perpetuity. And I'll just give you the idea that in a perpetuity, if you can earn forever more than what is expected for a level of risk, you crowd out the entire market and you become the market. No one will ever accomplish that. And so the point is your G is always bounded, cannot be higher than your WACC. And that's just math. So, because we're talking very, very long-term growth rates, like perpetual forever, as opposed to 5-year growth rates. So when you do key value drivers, think about that as G. Okay. And last point that you didn't ask, but is very important. You need to understand this in the real world as well as this class. G refers to growth in profits. It also refers to growth in sales. And we will use that interchangeably because if your margins are constant, growth in profits equals growth in sales. And so that's why people will use growth in sales and growth in profits as a proxy for growth. However, if the margins change in the future, then that breaks down. And the real G is based on growth in cash flow. And so here's the point. Growth in profits is a proxy for growth in cash flow if the level of reinvestment stays the same. And if the level of reinvestment stays the same, growth in profits, growth in cash flow, and growth in revenue are interchangeable. But again, if a company's growth in cash flow changes because reinvestment rate change, then that also breaks down. But that's the proxy that people use. So you can use it in this class. So you can talk about growth in sales as a proxy for growth in profits, but just understand you're making some assumptions when you do so. And we do this in the real world all the time, but that's actually what it's based upon. But regardless, G can never be higher than WACC in perpetuity. That's a math error in any class. Other questions, comments, concerns? All right, and again, everybody should be in a group at this point. I would suggest, regardless, Jacob, Mark, get in a group. At this point, you can pick whoever you want. It looks like this team only has 3 people. So Project 6 is probably looking for some people. But essentially, these teams in a few weeks are going to pick companies. So you might want to start meeting your teammates. You don't have a group project yet, but it's coming up soon. And you'll start kind of shadowing the assignments that we're doing as a group on a company that you will pick. And I'll give you the data for that. So again, if you have any other questions, please feel free to reach out to me. On the syllabus is my phone number. That's my iPhone. You can text, email. Please don't call unless it's an emergency. If you have any issues with classes, whatever, send me an email, preferably in advance. Otherwise, good luck, and I'll see everybody next week, same time. And this video link should be recorded and posted on YouTube shortly.
Thank you. Good night.
Professor.
All right, have a good night. Bye-bye.
Thanks, Professor.